Lease term looks simple until you start applying it. Avoid a compliance car crash by getting the lease term wrong. The lease term under FRS 102, simple in theory, risky in practice. On paper, the lease term under FRS 102 looks straightforward. You start with the non-cancelable period, adjust for extension or break options, and apply the reasonably certain test. But in practice, it's rarely that clean. If you're working with rolling leases, break clauses, or expired agreements, you already know how quickly a clear formula becomes a judgment call. And when lease term is wrong, the consequences go beyond a technical error. It can mean restatements, reversed entries, and difficult audit conversations, where things get messy. The moment you move beyond the non-cancelable period, judgment takes over. And that's where the real risk begins. Reasonably certain, a threshold that depends not just on what's in the contract, but on commercial reality. Your business model, investment decisions, past behavior, and even local norms. So, what makes it complicated? The revised standard introduces judgment. And that's where risk enters the picture. You're expected to assess not just the contract, but the commercial reality behind it. So, you need to consider whether the lessee is likely to renew, whether break clauses are realistically going to be used, if fit-outs or leasehold improvements have tied the business in, and even what's customary in your market or sector. It's no longer about what the lease allows. It's about what's reasonably certain to happen. Classic grey areas. Let's talk through a few real-world scenarios that regularly cause confusion when it comes to lease term. Scenario 1. The rolling serviced office. You've got a serviced office on a 1-month rolling notice. There's no fixed end date. But the business already knows it'll be there for at least a year, maybe longer. On paper, it looks like a short-term lease. But under FRS 102, the question isn't just about the contract. It's about what you're reasonably certain to do. So, if staying put for 12 to 18 months is a clear expectation, that lease term could very well be longer than just 1 month, even though it's technically cancelable at any time. Scenario 2. The expired lease still in use. Here's another one I see a lot. The lease has expired. No new agreement has been signed. But the asset, whether it's a property, a vehicle, or a piece of equipment, is still being used by the business and the lease rentals continue to be made. So what do? There's no legal renewal, no formal extension, but operations are continuing exactly as before. In this case, the lease term isn't defined by paperwork, it's defined by behavior. You've got to look at how long you're reasonably certain to continue using the asset and build your lease term judgment from there. Scenario 3. The short-term lease you never left. One that trips people up all the time. You initially treated the lease as short-term. At the time, that made sense. Maybe there were plans to relocate, or it was meant to be temporary. But here you are, a year later, and you're still in the same place. In that case, the facts have changed. What started as a short-term lease may now need to be reassessed. And if your original lease term judgment no longer holds, you may need to remeasure the lease and update the accounting accordingly. Each of these examples seems straightforward at first. But once you apply the reasonably certain test, you can see how quickly lease term becomes more than just a contractual detail. It's about intent, behavior, and commercial substance. Not just what's written on the page. The real risk when judgment goes wrong. Getting the lease term wrong doesn't just trigger a quick correction. It can cause real disruption, both in your numbers and your reputation. First, unwinding prior entries. If the lease term you use turns out to be incorrect, you may have to reverse the lease liability, write down the right of use asset, and unravel the depreciation and interest that's already been charged. It's not just one line in the accounts. It can affect multiple balances. Second, restating opening balances. If the lease began in a prior year, the correction doesn't just apply going forward. You may need to adjust your comparatives, which means reworking previously signed-off figures. This can delay reporting and require additional sign-off at senior levels. Third, disclosure adjustments. A change in lease term affects your entire disclosure trail, lease maturity schedules, expense reconciliations, even your narrative in the notes. It creates inconsistencies that auditors will flag and may require explanation to your board or stakeholders. And fourth, the loss of credibility. Perhaps the biggest cost is trust. When auditors, management, or internal reviewers lose confidence in your lease data, it raises wider concerns about governance, judgment, and the quality of your financial reporting processes. And the frustrating part, in many cases, these issues are avoidable, with stronger upfront judgment, clearer documentation, and a willingness to challenge assumptions that feel too convenient. Real-world experience. When auditors clash. I've worked with teams that got this right and teams that didn't. And when it goes wrong, the fallout can be significant. In one case, group auditors accepted a long-term lease term assessment based on commercial rationale and management intent. But local auditors pushed back hard. They took a strict legal view, focused on the rolling notice period, and refused to accept the judgment applied. The result? Our strong case and documentation, we managed to avoid unwinding the entries and recalculating the lease. Liability, update the discount rate, restate the prior year opening balance, and rework disclosures. And it doesn't take much to end up in that situation. Say you're in a serviced office on a 1-month rolling contract, but you know the business is planning to stay for the foreseeable future. Short term, maybe not. Or you've got a lease that expired, but the asset's still in use. No formal extension, just business as usual. Or you treated a lease as short-term based on initial plans, but 18 months later, you're still there. Each of these might seem reasonable until the audit team takes a closer look. What you should do. So how do you get ahead of the risk? Start with clear documentation. If you believe it's reasonably certain the lease will continue, write down why. Reference the business rationale, fit-out investment, or prior behavior. Revisit assumptions when facts change. Just because something was short-term at the start doesn't mean it still is a year later. Align your approach across teams. If you've got group and local auditors, make sure your assessment holds up from both perspectives. And where there's any uncertainty, get support. The cost of expert input is nothing compared to the time and credibility you risk by getting it wrong. Slide 8. Final thought. Big consequences if you misjudge and get the lease term wrong. When in doubt, don't go it alone. Get expert advice to protect yourself from restatements, audit issues, and reputational damage. For broader insights, practical tools, and step-by-step support across the lease accounting journey, visit our Knowledge Hub, built from real-world experience.